What we're going to be going over here are equity securities with a fair value option for holding an investment ownership of securities of another company. And for example here, Corporation A purchases the stock here of Corporation B and has equity ownership here, interest between 20 to 50%, and they elect to report the security using the fair value option versus the equity method. So if they were holding between, in this case, they're going to be purchasing 25% of the stock here of Corporation B here, and if they're holding between 20 and 50% an equity interest here, they would normally have to use the equity method here to record this investment, but they have the option to use the fair value option method here. So that's what we're going to be looking at, this fair value option here versus the equity method here. And for example here, Corporation A acquires 25% of the 200,000 shares of common stock here of Corporation B. So they're going to acquire a 25% interest here in Corporation B, and the cost that they paid here at that time was $28 per share, and Corporation B here has paid a cash dividend of $150,000 for the year here, and Corp B also reported net income of $244,000 for the year. And the other thing we have to note here is the market price of the common stock here of Corp B here was $30 per share here at our reporting date that we're going to look at 12/31/X1. Okay, so first let's go down and look at the guidelines for this fair value option here. So point one here, if elected on an investment by investment basis, that's an individual basis rather than on the total portfolio of the stocks that the Corporation A would be holding in this case. We're going to, when you use the fair value option, you look at an investment by investment or the individual basis for each of the stocks that you're purchasing here as an investment here. And two here, it's generally available only at the time the company first purchases the securities. And three, once chosen, you must measure the security at the fair value until it's no longer owned. So you have to continue on with this fair value option. Have to select it when you purchase the security, make the selection when you purchase the securities, and then you have to continue on with that option until you dispose of the securities or you no longer own them. Okay, so let's go up here and let's look. First, we're going to be looking at reporting this investment just using the equity method, which we normally have to do here. And this is where the fair value option is not elected here. And again, ownership between 20 to 50%, use the equity method. In this case, we're going to have a 25% holding of the common stock here of Corporation B. So we have to use the equity method here. So first, what we would do here, we would set up we have an investment stock account here, and it would be for the total portfolio. Here we're only looking at one stock, but you would set up this account here based on the portfolio of stocks that you're holding. And again, what we're gonna do here we're going to record this investment here. We record it here as an investment stocks here, and we're going to record it at the cost. So there was 200,000 shares of Corp B, 25% were acquired at the cost here of $28 per share. So we debit or increase our investment stock account here by $1,400,000, and then we'd credit our cash here for what we paid here, $1,400,000. Okay, so now this is where the equity comes into, equity method here comes into play, and it's all going to be working off this investment stock account here. So first, let's look at the case here of those dividends here. Corp B had paid cash dividends of $150,000 for the year here, and Corp A would get 25% of those dividends for $37,500. So what you do here, you don't go up and you record any dividends on your income statement. What you do here with the equity method here is you reduce your investment stock account here by the amount of those dividends received here. So dividends received reduces the investment carrying amount here of our portfolio stocks that we're holding here. So would credit that here for $37,500, and then cash we would have received here, debit that here for $37,500. Okay, so the next thing we have to deal with is this net income here for the year. So Corp B here has $244,000 worth of net income, and in this case, Corp A is going to share in that net income here. So what they're going to get here is, well, $244,000 times their 25% ownership here in Corp B. So what they're going to get here is net income they're going to get, and they're going to recognize it here as a revenue investment here on the income statement. So they would credit their revenue investment or recognize it as income on the income statement here by $61,000. And then what they have to do here in that case, when they get that net income, what they're going to do is they're going to increase their investment stock account by the amount of the net income that they would be allocated. And that we would debit or increase our investment stock account here for $61,000. Okay, so you see what's going on with the equity method here. For revenue, its share of net would go of the net income, the share that you're getting of net income here goes against this, would be recognized as a revenue investment here on your income statement, and the balance would go, and the balancing account would go to debit here your investment stock account. So what this net income doing, it's increasing your investment carrying amount here. So for any net income that you're allocated here, you're going to increase your investment stock account based on a portfolio basis, and any dividends received here, you're going to be reducing your investment stock account. So that's a straight equity method. And then again, there's no fair value adjustment to this investment account. All it is increased here for any net income allocated, and decrease it for any dividend received, cash dividends received. So that's what's going on here. Okay, so now let's go down and let's look at reporting these equity securities with the fair value option here. So normally we looked at the equity method that we had to use. Now we're going to look at the fair value option. So again, what you do here, your investment at the cost here, you set up that investment stock account, same as you did up above here, but you do it on an individual basis. So you would have it for Corp B stock here, and you're looking at these investments on an individual basis. So we only had one stock that we're looking at here, but if you had multiple stocks that you're holding, you'd look at them, you'd set up an account for each one of those stocks. So again, at the cost here, 200,000 shares, 25% interest in the company at $28 per share. So same as with the equity method here, you debit it for $1,400,000, and then credit or reduce your cash here for what you paid here, $1,400,000. Now we have to deal with that dividend. Before, with the equity method, the dividend received here, the cash dividends received, reduces the investment stock account here. But with the fair value option, all we do is we recognize it as dividend revenue here, again for individually here for that Corp B stock here on our income statement. So it's like you would normally receive a dividend in a normal situation. So what we would do, we would credit it for $37,500. So that was the $150,000 here for Corp B, their total cash dividends. We get 25% here, credit it here on your dividend revenue on the income statement here for $37,500, and then cash, we would have debited that here for $37,500. Okay, so next we have to deal with well, normally we would be looking at that net income here for this from Corp B here, but when we're using the fair value option, we're not concerned with the net income. That's not going to become that isn't going to become a factor here. What we're looking for is the change in fair value at the end of the period or at the reporting period here. So this is where the fair value option comes into play. This is where we're going to look at the change in fair value, and we're going to just assign it to the investment account here. So with the equity method here, we didn't really have any change in fair value here. We were only looked at that net income and the cash dividends here. But with the fair value option, this is where you got to set up this investment account here, again on an individual basis here for Corp B stock, individual basis, and you got to look at the change in fair value here. So again, this is the case here. Market price of those shares here at the reporting period, end of the year here, was $30. Our cost was $28. So comparing our market to our cost, market's greater here by $2 here times the number of shares that we're holding here. We had 25% of the total 200,000 50,000 shares of Corp B here, so that's 50,000. So that's going to equal $100,000. So what we would do here is debit our investment account here. We set up this account here, investment account, debit it for $100,000. That's at the end of the reporting period here, 12/31/X1. So each reporting period, you have to look at the change in fair value on the your investment here, and look at the in this case the market price here versus our cost, and any change would, if there was a, in this case where market price is greater than cost, so we increase our investment here by $100,000, but if it was the opposite here, then we would be reducing our investment here. Okay, so we've taken care of this investment here for the change in fair value, but what's tied to the investment account here is this what goes to an unrealized holding gain or loss as part of income here on our income statement. So it doesn't go in with other methods available for sale and so forth. It's part of equity, but in this case it's going as an unrealized holding gain or loss on our income statement. In this case it's a gain here, since our investment had increased here by $100,000, the fair value change here. So debit our investment here for $100,000, and then the credit goes to our unrealized holding gain or loss here on the income statement for $100,000. So what we want to look at here compared to the equity method here, first point here, A, you do not report the share of net income or loss here. With the equity method, we had to report our share of net income as an increased our investment account here by the amount of the net income that we have here. Had it been a net loss, then we would have been with the equity method, we would have reduced our investment stock account here. But with the fair value option here, that isn't taken into consideration. I mean, it's not a consideration here. We just have the individual stock here, Corp base, and at its cost here. And then point 2 here, big point here, the dividends received, you would be crediting dividend revenue here, and you do not reduce the investment stock account. With the equity method, we were reducing this investment stock account for any dividends received, but when you're using the fair value option, you just go and instead you just recognize those dividends as dividend revenue on your income statement. In this case, we credited it for the amount of dividends received here of $37,500. Okay, so you see what's going on here with this fair value option, and we have to look at it in terms of the equity method here, because in this case we would normally be using the equity method here because we have that ownership between 20 and 50%, and we have 25% here. But with this we have that option, and we use the this is where we can switch to the fair value option versus the equity method. So with the fair value option, we set up this investment, and we do it on an individual basis. So whatever stocks you have here, you would do it individually here. With the equity method, you did it on a portfolio basis, but here it's on an individual basis. And with the fair value option, you have to look at this is where that fair value comes in. You have to look at the change in fair value at your reporting period. So you look at whatever the fair value is compared to your cost, and then you have to look at the holdings that you have in the company here, the percent of holdings, and that's going to give you your change in fair value. So any increases in fair value, you would increase your investment account here, and any decreases, you would reduce your investment account. And then the other thing is here, any changes in your investment account here get recognized here as unrealized holding gains or losses as income here on your income statement. So I guess that summarizes what we're talking about here with this fair value option when we're looking at it in terms of versus the equity method here, when we would normally have to be recording our investment here using the equity method.